My name is Mick Fox. So one of the final sessions here before we go into a riveting discussion about CMMC at the end of the day here. So the point of this panel, for those of you who are in the morning panel, is in the morning we were talking about CEOs and how they're developing value in their companies, or how they perceive they're building value in their company. And in that conversation we talked a lot about how to position yourself and how to work with the private equity out there and other folks that may purchase you. Well, now sitting in front of you are those individuals we were talking about. These are the private equity individuals who are out there scouring the marketplace, trying to find companies to acquire. And really the reason we wanted to have them up here to have a discussion is these are the individuals who every single day are looking at companies, trying to figure out what is the value of that company, because that is what those CEOs, why they're there, is to drive the value. So we're kind of bookending, if you will, the conversation from earlier this morning. So as I sit down, I just want to very quickly make sure that the proper introductions are made. Sitting up here with me is we have Jared Doskow, make sure I say that correct, from Macquarie Capital. Beside him is Manan Shah from Renovus Capital. And then beside him is George Wilson. Now George used to be a CEO of ECS, was a Technomile customer, but now is with Bluestone, advising Bluestone. So if you wouldn't mind, welcome them, and then let's get into some questions. All right, gentlemen, let me head over to my questions here, make sure I don't mess up my questions. So we all know that there's a lot of macro things that have occurred out there, and we agree we're not going to talk about the macro. We're not going to talk about interest rates or the elections or anything that may be driving the macro. We're going to keep this panel more focused on the, I'll say the more micro than those level of things. So as you introduce yourselves to the folks here, what I'm really looking for to start this conversation is every day you all are assessing companies. There's probably 3 to 5 key things that you're looking for when you're initially assessing the companies that you're looking to invest in. So as you introduce yourselves, and we'll just start here with you, Jared, and then work your way down to you, George. As you introduce yourselves, just walk through what are those things that you're really just right off the top trying to look for. I am going to drive later on into technology and how technology, so if you can have a technology flair, fantastic. If not, I'll drive into it later. But introduce yourselves and tell me what are those 3 to 5 things that you're really assessing when you're looking for the value.
Sure.
To value a company. So Jared?
Yeah, Jared Doskow, senior partner in Macquarie Capital's growth equity, private equity team. I lead our public sector practice, so everything we do, government services, government technology, highly regulated industries, that's me, that's us. What you're kind of asking about is, what do we look for in businesses, or what do we, how do businesses maybe as sellers, how do you drive an outsized return is almost another way to think about the question, and really that comes down to differentiation, specialty, like being known for something, being good at something, having a reputation at something, and hopefully having that reputation outside of a process, because learning that this business is super, super special for the first time is a little harder than being known for something for years and being sought after. And a lot of what we look for on the way in, especially as it relates to on the way out, is how do you create a premium business, or a business you think can sell for an outsized return, especially compared to its peers, which once again is really about specialization. And if you think about what that means, it's filling a portfolio gap. And today's businesses are scaled of $5, $6, $10 billion. So being specialized in that lens is actually pretty difficult. But if they're going to buy you and spend your peer set is worth X, but you're worth north of X, you have to be that special and differentiated business where if they miss, there is a lack of alternatives out there, which is what drives sort of the premium value.
Perfect, thank you, and welcome. Manan?
Yeah, thank you. So at Renovus, we are normally looking at businesses that are founder-owned, founder-led. A lot of these businesses where founders have really spent 15, 20 years of their lives building those businesses to a certain level. They've created some unique value proposition within the business that might have a great market potential from a growth perspective, and can benefit from a partner like us who can come in and help unleash the value that the business might have by providing some more growth strategies, by helping kind of rounding out the management team, putting more thrust on the business development so they can scale and building the right infrastructure and right systems and processes. So as a private equity group, we typically look at sort of those type of elements. And one of the other advantages that we provide, we do have one of our funds is an SBIC fund. So with an SBIC advantage, obviously, if a company becomes part of an SBIC fund, they don't, if it's a small business set aside primarily driven by small business portfolio work, you can naturally continue that life under an SBIC fund without having to worry about, recertification and losing some of that, status. And so I think that provides a little bit more natural runway for some of these businesses while we start building a book of business on the full and open side. And, so it sort of becomes a transition strategy also for a lot of these businesses. So we look for, again, a lot of scalability, fragmented market, unique, unique value proposition to some extent, perhaps a great penetration within one or two different agencies where the customer really appreciates the kind of work they do and they want to continue to work with them. So we can maybe take that relationship and try to parlay that into other agencies and expand the portfolio work. So
perfect. I'm going to come back to something you said there in a moment, but I want to let George provide an answer. So
okay.
You want to drive?
Sure. George Wilson, I was at ECS I think we were there for about 10 years, working with Roy Capani, the founder. We took that from about 100 to $1 billion with acquisitions as well as organic growth. Prior to that, I was at a company called Stanley Associates, and Stanley Associates, I was employee number 20. We took that from 20 to 5,000, again, through organic growth as well as acquisitions. Now I'm with a group called Bluestone Capital Partners, and they invest in the lower mid-market, somewhere between 5 and 15 million. And EBITDA is typically the type of companies that we're looking at. And I'll have to say that what really attracts me to a company is the culture of the company, what they seem to have built. The technologies are incredibly important. They're differentiating or using the high-end technologies. There's a lot of businesses that are doing the services and they're not using the technologies or not differentiating themselves, trying to shy away from those. And then, as I've heard here mentioned too, for a company of that size, if they've had several recompetes and successful recompetes with a single customer, and they've developed a relationship with the customer applying their technologies, that tends to differentiate themselves particularly and protects them from the competition outside the market. And that then tells me that they know how to win, that they've worked together to grow, they've got a great reputation. And from that, you can then do the things that the private equity group would roll in. Again, increasing their business development, increase the scope, adding capabilities through acquisitions. But you can't fix the culture. So if the culture is not what you really need, then you're going to be doing an uphill battle from then on out. So I pay attention to the technologies, to the customer sets, as well as the culture of the company.
So same coin, other side, and George, I'll start with you and we'll come back. Is there something that immediately is a red flag where like that's going to drive the valuation, down? So is there something that you look at as something that devalues the company?
Well, I'll say something that's obvious to everybody. There's a small business component. Anytime you're looking at that, even a company that has reached the 100 to 200 million, typically they're going to have a small business component to them. So I wouldn't say it's a red flag, but people just look at it, okay? The other thing is you look at the management team. If a company is looking at selling and they've got a management team that rolled in there about 18 months ago, no, that's not what you're looking for. You're looking for folks that started filling the soda machines, as we used to say at Stanley Associates, that have been with the company from the beginning, have done a wide range of things, because that's what you do with a small business, and they're the ones that will stay with you after the acquisition to continue to grow it to a large thing.
Do you have an opinion on that?
Yeah, I mean, I would agree with what George mentioned. So management team is obviously critical, and we certainly put a lot of attention to that. Just making sure that they are aligned with our future objectives and how they plan to continue with their career post transaction under our ownership. Often some changes are inevitable when we go through this type of transactions, depending on the size and scale of the business. But we certainly put a lot of attention to the management team's continuity, and if we see a lot of issues, then that would be a red flag.
All right.
There are times where you meet businesses who have, on paper achieved lots of success, reached a good revenue, good backlog, good margins, good growth. But then you start asking about like what's next, and there's no good story there. It's like they got to the last 10 years all culminated in today, and they've like rung the bell and achieved success, but there is very little left, whether that's from them, they're ready to go to the beach, or whether that's the business. It's just sort of a wide array of mixed bag services where you meet the business, you're like, well, I don't know what to do with this yet, or what to do with this despite the fact that it looks successful on paper.
So no strategy beyond the exit. Okay.
Exactly.
So this is a technology conference, and obviously Technomile is a proud provider of technologies to government contractors. Does that matter? And they're not Technomile, but are they using technology? So when you all look at a company, the organization of their back office, whether or not they have technology, can you talk about, and I'll start with you, Manan, can you talk about, does that play a role? And if so, what kind of a role, what are you looking for when it comes to the back office, and specifically the technology of the back office?
Yeah, absolutely. I mean, I think, we do look at, whether or not there is any sort of adoption of technology in the back office, specifically in the accounting and finance area, in the in the business development, proposal, capture, strategy area, in the recruiting side of things. I mean, there are lots of good technologies available to really streamline and make those functions more efficient. So, and that might be, really for us, maybe a value creation area as we look at a new investment opportunity, because a lot of these founder-owned, founder-led businesses may not have uncovered some of the advantages that technology brings to the table. And, sometimes it's our job as the new partner to really help them focus on evaluating those technologies and then bringing them and implementing those technologies to drive, more value in the business.
Right. You want to elaborate any more, Jared?
I was thinking about it more from a technology, from a go-to-market perspective, right? If you think about these, it was on the CEO panel earlier. Someone was talking about, if it de-risks the business, if it reduces waste, reduces time to market, reduces costs, reduces people and friction, right? You've got a business case, you've got my attention, right? That's effectively. That's what you're looking for. So when services providers have one or two solutions in market, you look at their pipeline, they've got one or two more coming. You look at the way out ideas, there's one or two more. You've created a repeatable framework, something that we look at and think, well, we can do that more and more, and you've created then a durable business, and a durable business is just inherently sort of worth more than not.
Perfect. George, you want to bring us home on that?
Sure. And it's something that I worked hard at Stanley to put new technologies into the processes we did. We did it more at ECS, CMMI, ISO certification such. I'm amazed now that looking at the companies, what has changed just in the last 4 years. The insertion of technologies and AI into the back office, the business development platforms, even the onboarding processes and everything. And the drastic difference between some companies that have not implemented it and the ones that have, it's just like night and day. So I would say that it is a big differentiator to see those things.
They manage the business through data, right? Through the way we would want to see it, less about feel, that's still relevant and important, but more about business objectives, defined measures, success. It does make a bit of a difference.
And we've seen sort of, a lot of our companies that we invest in, the second or third tier management team within the companies really don't have access to very critical data that drives performance. And so to create that visibility across the board from top to bottom so that everybody's looking at the same set of data and, they're measured against the same set of metrics is, one of the first things that we try to focus on as we invest in a company.
I don't want to sound like a dinosaur, but the management walking around. I remember people saying, don't just send an email, get up and go talk to them. But once you put these systems in place and the people, and the way that we're operating now, or we've learned how to operate after COVID, you have people that are operating remotely, using the same data set, coming to very good conclusions and moving things and forward in organizations in ways that we wouldn't even think about 10 years ago.
So you all invest in different varying sizes of companies. And so you said something interesting that I wrote down here that talks about, it sounds like you, and I think all of you do this, have a playbook of acquiring a business that maybe is small, and George, you said this, maybe has a little bit of small business on their pipeline or in their contracts. And it sounds like you all have either an expectation or a playbook to advance a company from being a small business to then scaling up. Bringing, again, back to technology, do you have certain milestones, dollar milestones that you're expecting? Hey, if it's a $20 million company, I expect this much back office process and technology. If it's a $100 million company, I expect. So do you all have certain metrics that you're looking at and expectations when you run into a company about technology and where they should be with that? Or is that just based upon the market they're in? So I don't know, this is a question I didn't pose to them beforehand, so I'm catching them off guard here, but do you have a thought on that?
Yeah, there's no benchmark that I know of that we have in mind, but you do expect to see, as a company's gotten larger, that the maturity of the back office systems have grown with the company.
So if I came into, if here I am running a $50 million revenue business, what would you expect me to have in my back office at that point?
Strong contract compliance, strong business development pipeline, strong HR systems, onboarding processes, those type of things. They should be in place by that time.
And then if I'm a $500 million company, is it a different answer?
Yeah, they've gotten all messed up again.
True statement.
I would just, sort of maybe change that a little bit in the sense that, 50, 100 million, even up to $100 million companies that we would look at often don't have a lot of things in place. And so that's part of, because they've grown on the heels of a couple of big contracts, and all of a sudden they've got to 50, 100 million in revenue, and they've not really focused on building the right infrastructure, the right invested in right systems, processes. It might be all over the place that we have to come in and fix and centralize, streamline. We combined 4 different companies last year and had to really integrate everything under one system, one benefits plan. And it took us, 6 months to get there, which is not bad, but still it was a pretty heavy uplift that, shifted management's focus away from growth. And so, those things are part and parcel of, the things that we do for the businesses that we invest in. But still underlying core thesis is always strong. They have some good capabilities and good things going for the business. Now we need to provide some more help after we sort of create this back office infrastructure.
Do you have a varied opinion? Additional?
We actually do keep benchmarks. We have the benefit of seeing a lot of businesses, meeting a lot of companies at various stages, like you guys do. And I only say that as it relates to sort of as presented financials, right? So if you're a $50 million business making $5 million of EBITDA, it's like, well, is it really 4 or 6? And so it helps you understand, is there synergies or dyssynergies? That's easily solvable. So it's not like it's a category error or a do not pass go, but it helps you understand in a more informed way what you're really starting with.
So you do a lot of advisement to companies as well as you're assessing them. And a lot of the audience out here are folks that do contract management, who do growth within those companies. If I can get very, very tactical here for a moment, down into, now I'm talking at, hey, if you're using a system, do this, do that, because your boss needs this information, and what information does their boss need? So if you're specifically talking to the folks who are actually in there running the company, the contracts administrators, the capture managers, if you will, what advice would you give them to try and help their company achieve the value, to try and help their boss, try and help the CEO achieve the value? So if we can get really tactical here, if you wouldn't mind, what would that advice be? I'll start back over here with you, Jared.
Sure. I mean, everything really has to align to a strategy, right? So it comes down to what do you want to be when you grow up? And I remember we met this company years ago that, achieved success on paper, and we started poking around in the waterfall and asking questions, and she kind of stopped the conversation and said something like, you have to understand, for the last 15 years, we've lots of forks in the road, some easy choices and some hard choices, right? Easy choices, keep the business small, keep doing what we're doing, beat the folks we've beat before. Hard, more long-term value, but what if we lose? And she's like, for 15 years, we've chosen the easy choice, which is every single time. And that there's a profound statement that it's like, you're buying a business that's absence of strategy or devoid of strategy, and you're basically buying a project as opposed to a platform. And so I guess my tactical advice is, all this has to align to a strategy and where you're going, who do you want to be when you grow up?
I would say, I think understanding your underlying contracts and how they're set up and what is sort of the margin profile, what is your subcontractor usage on each of those contracts, whether you have, rooms for improving those margins, improving, how you are delivering to the customer. Obviously, as a company, if you are providing more of the services through direct resources as opposed to subcontractors, that always benefits the business that you're running and creates more value, right? So trying to see, but there might be other reasons and rationale why you're relying more on subcontractors, right, to deliver some of the value. So, trying to look at that, creating more visibility, understanding what that profile looks like, when do these contracts come up for recompete, and then what's your recompete strategy. So focusing on some of those key areas, as you're running a smaller company, I think is critically important, because you want to protect the business you have first and foremost before you start looking at, growing the business and expanding into other areas.
I'm going to come back to that in just a moment. George, do you have any tactical advice?
Sure. We've all been in businesses. We're all trying to grow the business, ultimately sell the business. I mean, that's just the nature of this industry we're in. That's why we're up here buying businesses, selling businesses. My tactical advice, no matter what you're involved with, is try to get together with the other organizations and talk about how do you value that business? How do you value the business that you are part of? Whether that be EBITDA or the percentage of full and open contracts versus small business contracts, whether it's time and material contracts versus cost plus with lower margins and things like that. Whether it's organic growth or whatever it is, but come together and talk about that so that you evaluate the company together with all those terms. Because at that point, then you're all on the same page in terms of what you're trying to focus on. And it's not just EBITDA. People talk about turnover rate. People talk about, are you doing high-end contracts versus low-end contracts? Service level versus software development, those type of things. Once you get once you share that information and discuss those type of things, now you can really focus in on doing things that improve the value or increase the value of the company. Now you're all on the same page. That's what we're supposed to be doing. So, and it's easier to explain that than when you're sitting around saying our turnover rate is this. That's really high in the industry standard. Yes, that's true. We ought to get it down, but why? What's the value of having a low turnover rate? And when you start talking about those things in the context of creating value that you all are part of, it's a different conversation, and I found that to be a good way of approaching it.
So our get off the stage question here, and it's something that each of you just got done talking about, and Manan, you actually touched on this earlier. You all have. It's managing the business through data. So the folks out here in the audience are a lot of the folks who produce the data. Who the CEO says, I have another data call for you, and then they hang their head and they have to go get the answer for that. So that way we all are on the same page. Typically, if you can look at it from two different perspectives, that's the pre-award data, whether it be pipeline, et cetera, so the growth data, or from current contract data. What are the 4 or 5 pieces of data that we all need to make sure that we absolutely have on the ready, so that way we're doing our job for our CEOs, because we know that they are responding to people like you. So if you don't mind, Manan, I'd like to start with you. Just what are those pieces of data that ultimately, hey, you just have to have?
Yeah, I mean, obviously, starting from the, top level at revenue and EBITDA, understanding where it stands, month over month, and what the projected profile looks like, that's pretty critical in any business. Contract backlog, what's that backlog number? Obviously in this business, we win backlog and then we consume backlog. As you consume backlog, that backlog number comes down. So how fast are you replenishing it? So then, what's been your P-win with the pipeline? I mean, especially with regards to the new opportunities and also recompete. Recompete should be pretty high. We would expect most of the time the recompete P win to be in the 90+% range. But the new opportunities is where you kind of measure whether your sales engine is really successful or not. So that's another critical data. Employee retention or employee turnover data, whichever you want to look at. So those things are in book-to-bill ratio, as we sort of look at each business. So these are sort of 4 or 5 things that I would say first and foremost that comes to mind.
Perfect, thank you. George?
What's our revenue target? How are we going to get there? And it typically means you're going to execute on your existing contracts, maybe grow a couple, and then you've got some key opportunities that you either have to win or not. I always, we talk about P wins and things, and I always laugh about it because I've never won a half a contract yet, or a 0.25 or 0.6. You either win it or you don't. It's either 1 or it's 0. What do I have to win to get to that revenue target? And then you assess what's the risk of that, but that's more of a gut feel than anything else. And then how am I spending my indirects toward that target? And if I feel more risk, then we have to pull back on the indirects. If I feel like we're going to do really well, then you increase the indirects and make the investments that you have to make. So that's the biggest thing. How am I going to get to that revenue target? And then assuming that we're going to run the business the same way that we always have, then you kind of understand what's going to fall out on the backside as far as the indirects and then ultimately the earnings.
All right, Jared, bring us home.
We've focused the same way as George kind of laid it out, right? Revenue as being sort of the number 1 through 5 sort of focus area, right? What is our base? What's our on contract? What's our new business identified? What's the wedge? What's the upside? What's the downside? When do these things come in? Because from there, the rest of the business falls into place, right? You can manage certain aspects underneath revenue, but revenue is the thing that you need to win first to govern or to sort of decide from there. And then maybe just another, we always found this self-service, right? So as opposed to asking for the data call and then delivering this data report, companies that have more of a self-service delivery, folks in the company, first level, second level down, can get to what they need on a daily basis, or that we find very helpful, because then there's not this second, third line of questioning. It's all real time.
Perfect. I don't know, I'm trying to look at my timekeeper. I want to open this up. I know it's just for 1 or 2 questions, because you don't always get access to gentlemen like this. Are there any questions in the audience that you would have for investors such as these? Just wanted to make sure everybody's questions were getting answered. All right, so with that, then thank you, gentlemen. I have a little bit of get off the stage here that I'm supposed to read here. First of all, I want to thank each of you. I know it's been tedious to try to always get together, but I cannot thank you enough for all the input and advice that you provided. So first of all, if I can get a round of applause for our panelists, I appreciate it. Folks, these are the real deal. So if you actually want to spend some time afterwards with them to actually ask the real questions that you wanted to ask, I would highly recommend doing that. I'm supposed to tell you, let's see, as a reminder, today's sessions are being recorded and will be sent to all attendees later this month. We're going to take a 10-minute break and then reconvene promptly at 3:50 in the Regency Ballroom. That's the main ballroom over there, to talk about the funnest subject on the planet, which is CMMC. We're going to try and talk about CMMC, Simplified Navigating Compliance and Confidence. And then, as I said, that the panel will stick around for a little bit. If you had any questions that you didn't want to ask in the larger group but would like to ask them privately, you're more than welcome to do that. But gentlemen, thank you very much for your time.
Thank you.
All right, thank you, Aaron.